Welcome to the deep dive. Today, we're navigating a very volatile space, software infrastructure. This is really the bedrock of the AI revolution, and while the potential is massive, so are the price swings. We've put together a pretty comprehensive journalistic report on the three stocks driving the highest trading volume in this sector right now.
That's right. We're going to cut through the noise and dive deep into, first, Datavault AI, that's DVLT, then Palantir Technologies, PLTR, and finally, CRWV, CRWV.
And our goal for you is simple. We want to give you that synthesized knowledge, the basic facts, the technicals, financial health, news.
And the valuation. We'll even run a hypothetical $5,000 paper money scenario for each one just to illustrate the concrete risks and rewards involved.
Think of it as your shortcut to an immediate, well-informed perspective on what's happening at the bleeding edge of the market.
And look, before we get into any of the details, we do want to be completely clear. This entire discussion is based purely on the provided public data. It is for informational and educational purposes only. This is not, and it really should not be seen as, investment advice.
Okay, with that said, let's unpack this first contender. A very high-volume, high-stakes company known for its massive volatility. Datavault AI Inc., ticker DVLT.
Right, DVLT. It's a really fascinating portrait of speculation in the AI age.
And it's a micro-cap, isn't it?
It is, absolutely. At a last close of $1.87 and a market cap of just over $500 million, $541.68 million to be exact. This is the textbook definition of a microcap stock.
Which, for context, means that those enormous price swings are just part of the deal.
Completely. I mean, even small trading volumes can drastically move the share price. And their business model is, well, it's ambitious. They're focused on AI-driven data experiences, but also heavily into Web 3.0, asset valuation, that sort of thing.
Using some patented tech and acoustic science, I saw.
That's it. Now, if you look at the price action, the performance is just wild. Over the last quarter, DVLT delivered a staggering gain of over 329%.
329%. That is explosive.
It's explosive top-line momentum. But, and this is a big but, if you zoom out to the year-to-date chart, it's still down around 9%.
Wow. That discrepancy really highlights the volatility, doesn't it? Those weekly and monthly readings are over 20%.
Exactly. So let's look at the technicals because they tell a similar story. Short-term weakness colliding with long-term strength.
Okay, so where is the price right now?
It's currently trading about 12% below its 20-day simple moving average, the SMA 20.
Which is that key indicator for short-term momentum. So momentum has faded a bit.
It has. But, and here's the major bullish signal, it's trading over 93% above its long-term SMA 200. So that incredible recent run is still, fundamentally intact on the chart.
So for a technical trader, what's the immediate buy trigger here? What are they looking for?
They're looking for a renewed, decisive move back above that SMA 20 that would confirm the momentum is back. And this is supported by, well, the one analyst who covers the stock. It's just one. But they give it a strong buy recommendation with a pretty ambitious $3 target price.
That suggests a lot of confidence, which kind of contrasts with the financials, doesn't it? We have to pause and look at those because they are truly shocking.
You're absolutely right. The market is clearly not pricing this based on current earnings. The numbers are alarming.
Okay.
So despite a huge jump in sales quarter over quarter, almost 148% growth, they are losing money on every single service they provide. Their gross margin is a negative 100.93%.
So they're not even covering the direct cost of what they're selling?
Not even close. And the overall profit margin sits at a dizzying negative, 1,527%.
How does a company even stay solvent with numbers like that?
They raise capital and they survive on expectation, on hope. The valuation ratios prove it. Their price to sales is 87.79.
87. For context, a healthy, profitable tech company might be, what, 10 to 20?
Exactly. 87 means the market is pricing in decades of flawless, massive growth that just hasn't happened yet. And their liquidity is low, too. Current ratio of just 0.68.
And the news flow seems to reflect this high-stakes, almost promotional environment.
It does. We've seen positive news around RWA real-world asset tokenization. They secured a multi-million-dollar services agreement with a company called Triton Geothermal.
Right. And the big one was the massive corporate development, that $150 million strategic investment from Silex Holdings.
Yes, specifically to build a supercomputer. That signals a serious intent in the AI infrastructure space.
Yeah.
And then you get the speculative kicker.
Do meme coin.
The Dream Bowl draft meme coin distribution to shareholders.
That is just, so 2025, you have this serious tech investment on one hand and then highly promotional speculative incentives on the other. It really shows that high-risk, high-reward positioning.
It really does.
Okay.
So let's run the paper money math on this high-risk scenario. Say you invested $5,000 at the recent close price of $1.87. You would acquire 2,673 shares.
And if that massive speculation pays off and DVLT manages to get back to its 52-week high of $4.10, what's the gain on that?
The profit on those 2,673 shares would be $5,942.21.
So your $5,000 basically doubles.
Your total paper investment shoots up to over $10,900. It's a really powerful illustration of the leverage you get when one of these low-price, high-volatility stocks actually works out.
Okay, so let's move from that microcap gamble to a global S&P 500 powerhouse, Palantir Technologies Inc., PLTR.
A completely different beast. PLTR operates on an entirely different scale. Closing recently at $171.25, its market cap is over $408 billion.
This is the established giant. They build the software platforms for massive scale data analytics used by, well, the U.S. military, intelligence agencies, huge commercial clients.
Major healthcare systems, yeah. They're the real deal. And the long-term trend confirms that leadership, year-to-date gains are over 126%. Annual performance is over 182%.
The short-term chart looks like it's hit a wall. It looks like a pullback.
It's definitely a correction. PLTR has been caught in this broader AI sell-off. It's showing significant weakness recently, down over 11% this past week.
And what do the technicals say?
Technically, the price is below both the short-term SMA 20 and the medium-term SMA 50. That signals that the short-term selling pressure has completely reversed the momentum.
Okay, and the relative strength index, the RSI, where's that sitting?
The RSI is at 42.24. Now, remember, below 30 is generally considered oversold. So at 42, it's approaching oversold, but it's not quite there yet. It's not flashing that immediate bounce signal.
So the buy trigger for traders is a move back above, what, the SMA 50?
That's the one. A definitive move back above the SMA 50 would suggest the selling pressure is exhausted, momentum's back, and that would align with the analyst target price of about $189.
What's so fascinating here is the contrast. You have this technical weakness, but the underlying financial strength is, well, it's the polar opposite of Datavault.
It really is. The financials are rock solid. Gross margin is over 80%.
80%.
Profit margin is a very healthy 28.11%. Liquidity is superb, with a quick ratio of 6.43, and their debt levels are extremely low. This is a genuinely profitable, cash-rich company.
But the valuation is where all the anxiety is, right? That PE ratio is over 400. That's a number that makes even the most aggressive growth investors start to sweat.
It is an astronomical valuation. And we need to unpack what a PE of 400 actually means. It means investors are willing to pay $400 for every $1 the company earns.
To put that in perspective, the average tech stock might be closer to 30 or 40.
Exactly. A 400 PE doesn't just price in future growth. It prices in absolute, flawless, transformative success for the next decade. This is why investors are betting on such massive growth. Their EPS is projected to increase nearly 50% over the next 5 years.
And the recent news is just full of drama around this exact point. You've got Jim Cramer saying he's not concerned about the dip.
But then you have famed short seller Michael Burry, the guy from The Big Short, betting against the stock.
And that seemed to trigger the CEO, Alex Karp, who publicly laughed out at what he called parasitic critics.
Yeah, referencing not just the valuation debate, but also those long-running concerns over the nature of their government surveillance work.
But despite all that drama, they keep booking major wins. A partnership with FTAI Aviation for engine maintenance, involvement with the UK's NHS data platform.
Right, the business keeps moving forward. So let's run the paper money scenario here to illustrate the downside risk of holding a stock like this during a correction. Say you had invested $5,000 when it was trading near its 52-week high of $207.
Okay, so at that price, your $5,000 would have gotten you about 29 shares. And with the stock now trading at 171 and change.
That's a pretty significant drop. It is. The estimated paper loss on that position from buying near the top would be $1,051.73. Your $5,000 investment is now worth just under $4,000. It's a vivid illustration of what happens when these high valuation giants correct.
Okay, our final stock, CoreWeave Inc., CRWV, Brings us back to that high-growth infrastructure story, but with the added layer of a recent IPO and a dramatic execution crisis.
Yes, CRWV is a key player in sophisticated AI computing. It closed recently at $75.33 with a $37 billion market cap. And while its year-to-date performance since its March IPO is strong, up 88%, the last few weeks have been catastrophic.
Catastrophic is the only word for it. The stock had its worst ever week, according to Bloomberg. It crashed nearly 29% to the week and over 44% for the month. The chart is just carnage.
And the technical setup confirms that panic. The RSI is sitting at an extremely low 23.31.
23, so that's deep in that oversold territory.
It's technically a screaming oversold signal. Now, that indicates a high potential for a tactical bounce if the core issues get resolved, but it speaks volumes about the level of capital flight from the stock.
Let's dive into those core issues because, like Datavault, the financial health seems to be a major concern here.
It is. They have negative profitability and dangerously high debt levels, a debt-to-equity ratio of 4.85. They're heavily reliant on borrowing.
But again, like DVLT, the growth story is spectacular, isn't it?
It is. Sales jumped 133% quarter over quarter. Investors accept these current losses because they believe that sales velocity will eventually, lead to profitability down the road.
But the insider selling seems to signal trouble. The sources show substantial, consistent selling by the CEO, the CSO, major owners. That's rarely a good sign for outside investors.
Not at all. And that selling was accelerated by the news that just crushed the stock. The recent crash was triggered by a guidance cut and the delay of a major customer contract.
Right. And that just magnified all the anxiety around execution risk, supply chain issues, and that broader fear that the AI bubble might be popping.
Jim Cramer called that news jarring.
Yeah.
And yet, the analysts covering the stock seemed completely unfazed. Their average target price is still a massive $131.92.
That divergence is incredible. It really highlights the battle between that long-term institutional belief in the CoreWeave growth story and the immediate emotional panic in the market.
Absolutely. So let's run this final paper money scenario, focusing on the pain of this crisis. Imagine you bought a $5,000 position when the stock was trading near its SMA 200 level of about $108 just before the crash.
Okay.
That would have bought you 66 shares.
And watching that stock fall from over $108 to $75.
Yeah.
What's the damage?
The estimated paper loss on those 66 shares would be a substantial $2,181.30. Your $5,000 investment is now worth only about $2,800.
Wow. It's a brutal illustration of what happens when a high-growth company hits an execution wall.
It really is.
So, to wrap up, we've seen three completely distinct portraits of the software infrastructure market. We started with Datavault, the microcap, highly promotional with its RSI sitting in a neutral 50 range.
Then Palantir, the established giant. Tremendous profitability, but hitting a technical dip over valuation fears, with its RSI approaching oversold at 42.
And finally, CoreWeave, the high-growth story facing an immediate execution crisis, which led to an extreme sell-off and an RSI all the way down at toggle 3.
And this really highlights the core tension you face when you're navigating this sector. The market is constantly weighing established strong fundamentals, like PLTR's margins, against the pure promise and explosive growth of the future that's demanded by companies like DVLT and CRWV, who are operating at deep losses.
And so the ultimate challenge for you, the learner, is really to ask, is the market correctly differentiating between these risk profiles right now? Or is this generalized AI correction blurring crucial distinctions and maybe presenting an opportunity or a major trap?
And that distinction between current performance and future promise, that is the essential knowledge you can extract from all this data. Thank you for diving deep with us.
We appreciate you sharing these critical sources. We'll see you next time on The Deep Dive.